Today we go into the fun and games of intercompany inventory transactions. Learning objective 1 is to understand and explain intercompany transfers and why they must be eliminated. And there are many different kinds of intercompany transfers that can occur. There's what we call reciprocal accounts. That would be receivables and payables, where one affiliate has a payable to the other, so the other has a receivable, and those would need to be eliminated against each other when you consolidate. You have inventory transfers that we're going to work with today. Chapter 7 goes into fixed asset transfers, in case you're interested in that, and intercompany indebtedness is in Chapter 8. In this course, we only cover Chapter 7, so that's all I have a video for. I will probably get emails from people all over the world asking, what about Chapter 7? What about Chapter 8? Well, you'll have to buy the book. Anyway, only arm's length transactions can be recorded as revenue with profit. In other words, in order to record a sale, you have to have a sale to an outside party, and a sale to an affiliated company, such as a subsidiary or a parent, even if there are two companies that are owned. So the only way you can earn revenues and profits is by engaging in transactions with outside parties. In other words, parties that you don't own, that don't own you, that don't have the same owner or anything like that. Other transactions, what we call non-arm's length transactions or related party transactions, or intercompany transactions are this type. There are related party transactions, by the way, where you can record a profit, but you have to disclose the nature of the transaction. But that's not what we're talking about here. We're talking about where a parent company sells to a subsidiary sells to a parent. It could also be a situation where two subsidiaries sell to each other. So these transactions may be recorded by one or the other, and that's what we learn in managerial accounting. In managerial accounting, you learn that you have transactions between affiliates. Let's say you own a factory and a store. The factory makes the goods and then sells it to the store, and we allow the factory to earn a little profit using a transfer price that gives that basically allows the factory and the store to share the profit on the item. But from a GAAP perspective, from a perspective of financial accounting, we would not allow the factory to record any profit until the goods are sold to an outside party. So this works within the company for its own records. But when you're consolidating, you have to eliminate all those sales and all those little profits, because you can only record profit when you sell to an outside party. So you're going to eliminate all intercompany transactions in consolidation, so that the consolidated financial statements only reflect arm's length transactions, transactions that are engaged in between independent parties. And these intercompany transfers must be eliminated. All aspects of them must be completely eliminated when you do your consolidation. So if you have payables and receivables between affiliates, they need to be eliminated. If you have a parent that holds stock in a sub, obviously that investment is going to be eliminated. Sales, purchases, interest, dividends, all this is going to be eliminated. It doesn't matter if the parent owns 100% of the sub. It doesn't matter if the parent owns 51% of the sub, or as long as the parent has financial control, then this is going to be a problem, and you're going to need to eliminate these transactions. So a 12-year-old girl lends $20 to her 17-year-old brother. As a parent of a 12-year-old girl and a 17-year-old boy, I can tell you that things like this do happen, without naming any names, of course. But these types of transactions do happen. And to the girl, to the sister, this is a receivable. And to the brother, this is a payable. But if your parent, if the whole family is going to do a consolidated balance sheet, then there is no $20 receivable or payable. They're going to offset each other. You're going to debit when you do your consolidation, you're going to debit the payable and you're going to credit the receivable. Here's another one. You have a parent that has 19 subsidiaries, receive a dollar order from an outside. The parent sells the inventory subsidiary 1 for $1. Sub 1 sells the inventory to sub 2 for $1. Sub 2 sells the inventory to sub 3 for $1. And it's sold from one sub to another all the way up to 19. So what you would have there is you would actually have $20 in sales, right? The parent selling $19 in sales from the parent all the way up to the sale from sub 18 to sub 19. So that would be $19 in sales that are recorded by the various subsidiary. And if you're going to consolidate all these entities together, then you're going to have $19 in sales. But from a consolidated point of view, no sale has taken place whatsoever. And this, of course, this would be a way to do a fraud. Sleazy parent has a sub and is preparing for an initial public offering. And sleazy parent also happens to own a lot of old inventory and it can't get rid of. And the inventory is on the books for $1,000. And it sells the inventory to the sub for $100,000, booking a $99,000 gross profit. And now the inventory is sitting on the sub for $100,000 and they consolidate the whole thing. Then you would have $99,000 in $100,000 in illegitimate sales, $99,000 in illegitimate gross profit, and you have an asset on the books for $100,000 that's only worth $1,000. So if you don't adjust for that, then your financial statements will be misstated and not in accordance with GAAP. I usually don't like to show elimination entries using traditional debit and credit format. So what I'm showing you here are actually, it says correcting entries. These are not correcting entries. These are elimination entries on a consolidation worksheet. So do not be confused. If you had an intercompany loan, what you would do is you would debit loan payable and credit loan receivable in your consolidation, you know, in the various different columns that are there. And it would, again, I never show these as debit credit, but the book does, so we might just to make that clear. If you had a sale from a parent to a sub, then that sale would be, and then the sub sold to an outsider, you would debit sales and you would credit cost of goods sold. To eliminate that sale, because really two sales took place. There was this sale from the parent to the sub, and then the sale from the sub to the outsider. The sale from the sub to the outsider is good. The sale from the parent to the sub is not good. So what you would do is you could debit sales, credit cost of goods sold. And the sales you would debit would be the value of the sale from the parent to the sub, and the cost of goods sold that the sub incurred when it had that sale between the two entities. Now, if it was a sale from a parent to a sub, but the sub had not yet sold to the outsider, you would need to eliminate a little more. You would need to eliminate the sale itself, because it's not a real sale. You would need to eliminate the cost of goods sold that the parent recorded, because that's not really cost of goods sold yet, because nothing has been sold. And the difference between those, right now, would be sitting in inventory on the books of the sub. So that unrealized gross profit would need to be deferred, and so you would credit inventory for the amount of unrealized gross profit. The gross profit that the parent recorded when it sold to the sub, that's not real gross profit, and it cannot yet be recorded. So let's do an example that has a little more detail to it. The parent loaned $500 to the sub, and there's no interest involved in this loan, interest-free loan. The parent made a sale to the sub for $400 cash, and the inventory originally cost the parent $250, and then the sub sold the inventory to an outsider for $500. So two sales were recorded for the same inventory. The parent sale to the sub for $400, then the sub sale to the outside for $500. And the parent also made a sale to the sub for $300. The inventory originally cost the parent $200, and the sub has not yet sold that inventory to an outsider. So let's see what would happen. First of all, we have this loan. The parent loaned $500 to the sub, and the parent at the time debited receivable and credited cash. The sub debited cash and credited payable. On your consolidation worksheet, you're going to debit loan payable and credit loan receivable as an elimination entry, because the receivable on the books of the parent for 500 and the payable on the books of the sub, when you consolidate, you would just get a receivable and a payable that are equal to each other, and to the outside investor looking at the balance sheet, it's not going to make any sense. Let's look at this third example. Parent made a sale to the sub for $300 cash. The inventory originally cost the parent $200, and the sub has not yet sold the inventory to an outsider. So this is where things get really interesting. Here's a picture of the transaction. The parent bought the goods for $200 and sold it to the subs for $300. So the parent debited cash for $300, credited sales for $300, debited cost of goods sold for $200, credited inventory for $200. The sub, when they bought the inventory, debited inventory for $300, credited cash. So what's sitting on the books right now? The sub has inventory on their books for $300, which really costs $200, and the parent recorded a sale of $300 and cost of goods sold of $200 on a sale that didn't really take place. So what happens in reality is that the parent bought the inventory for $200. That's it, and the inventory is still sitting on the books. So we need to undo this middle entry here when the parent sold the goods to the sub. That's really what we need to do. So again, the parent debited cash, credited sales, debited cost of goods sold, credited inventory. None of this really took place. And now the sub is stuck with inventory on their books for $300, which didn't really cost $300, it cost $200. So I'm going to debit sales for $300 because this isn't a real sale. I'm going to credit cost of goods sold for $200 because I haven't sold the goods yet, even though the sub has recorded $200 cost of goods sold. And the difference, the credit of $100, is going to go to inventory, which makes perfect sense because the inventory is on the books of the sub for $300 and it really only costs $200. So I got to credit the inventory for the difference. And again, these are summaries of everything that we just saw. Now, if you're using the fully adjusted equity method, which is what we're using in this class, then we're not yet doing, the parent is not yet doing the consolidation. So the parent may be recording sales to the sub and recording this excess profit that'll come out in the consolidation, but it would inaccurately indicate their income if they didn't consolidate. So we can't just do elimination entries. We're also going to need to adjust the equity method for these inappropriate profits. So let's say you have a sale from the parent to the sub, and the sub has not yet sold to the outside. That was the third example that I gave you. And so the parent recorded profit on this. What the parent would need to do is it would need to adjust the equity method income in the sub. Now you're saying, why does the parent adjust its own income and take out the gross profit? Because this transaction involves the sub, and so we want to kind of keep it with the sub. Later on, when the sub sells the goods to the outside, we can adjust the sub's income again. So what we do is a little strange. We actually adjust the income of the sub rather than the income of the parent. And here you can see what would happen. Let's say the parent buys the goods for $500 and sells them to the sub for $600. So the parent records a sale of $600, cost of goods sold of $500, and gross profit $100. The sub now has the goods sitting on their books for an extra $100, which didn't really cost them anything. The inventory had been written up by $100, which is not right. So what the parent is going to need to do is it'll also, in addition to the elimination entry and its consolidation, the parent, if it's going to use the fully adjusted equity method, it's also going to need to take $100 income back out of its books. And again, one way it could do that is to simply debit sales, credit cost of goods sold. But then what would the other credit go to? It would actually go to the investment account. But that's not how we do it. Rather, we keep this income with the sub. And so we debit income from sub and credit investment in sub. And this eliminates that fake gross profit that the parent recorded, and it keeps it with the sub because right now that gain is sitting on the books of the sub as inventory. And we like to keep it there where we know it is so that when we need to take it out, we know where to find it.